and I'm happy to introduce Tom Joyce of MUFG Securities America. Tom is Managing Director and Capital Market Strategist within MUFG Global Market, Capital Market and Investment Banking business. Based in New York, Tom heads a team that creates customized analytical content for multinational US corporation Fortune 500 companies. His team provides a depth analysis of impact of economic, political, public policy, and regulatory dynamics on US credit, foreign exchange rates, and commodity markets. It's my pleasure to welcome him back. He's been with us for the past 2 years. His prediction has been right on, so we're very excited to hear what you have to say this year, Tom.
Thank you very much for the kind introduction. Such a pleasure to be here in front of this forum for the 3rd year in a row. My name is Thomas Joyce. I am going to present to you today an abbreviated version of our comprehensive 2022 Global Markets and Economic Outlook. A reminder from prior years that my focus is on corporate activity within the global environment from an economic policy and market perspective. I present to CEOs, CFOs, and treasurers around the world. And the theme of our outlook this year is very much on how corporates, despite the higher volatility, despite the public health crisis, which does continue in its later stages, and despite decelerating global growth, the way in which corporates are transitioning from a strategic perspective toward a post-pandemic world. And as you see here in the table of contents on the deck that I'm going to go through, we'll cover many of these topics here today. If you look at the middle column, we're going to spend a lot of time talking about how, despite the dislocations in the global economy and the regime change underway in markets, that corporates globally, with their fortified balance sheets during the COVID period, are investing heavily in capital expenditures, as has happened historically during times of supply chain dislocations. The investment in productivity has been enormous, and we expect it to continue. We've had the largest M&A year on record. We have record buybacks, record dividends, record earnings and margins, and fortified balance sheets. And I'm going to spend the next 40 minutes taking you through our view on how we believe corporates are going to navigate what will certainly be a very complex environment in the year 2022. Let me start by quickly taking a short look at 2021, because many of these themes are very relevant to 2022. The year didn't simply begin on January 1st from an economic and market perspective. It's worth noting the formidable achievements from a public health, economic, and market perspective in a year in which things were so difficult. In just 1 year, the global economy has distributed governments globally close to 10 billion vaccines in 1 year. The economy, both the United States and globally, for much of last year was growing at 2 to 3 times normal rates. Of course, that was in part because governments globally spent over 30 trillion, think of that number, 30 trillion in monetary and fiscal stimulus. Consumers globally have saved in excess of normal savings, over $5 trillion, close to 3 trillion of that in the US alone. Profitability for corporates, revenue, earnings, margins, spent the year in record territory. Last year, we had the first 5 trillion M&A year in history. And it was the first year in which every single quarter of the year had over $1 trillion of global M&A. Corporates are active and they are putting their balance sheets to work. And the capital markets have been wide open and available to companies globally, despite the challenging environment. Last year was the first and second strongest year on record in the high yield and investment grade US dollar markets, the largest corporate financing markets in the world. And credit spreads spent much of the year close to multi-year decade tights. And so we entered this year with significant momentum, though we must acknowledge that the regime that we are in is changing. From an economic perspective, we are going from growth acceleration to something more like mid-cycle growth deceleration, from synchronized recovery to desynchronized and uneven recovery. Many parts of the world in 2022 will perform very differently from one another vis-a-vis what happened in 2021. We are going from decades of low rates and low inflation to rising and broadening inflation, to higher rates. And while unemployment levels might be at historic lows in the United States in particular, we also have record low layoffs, record high quits, and rising wages. Said another way, labor shortages are a new persistent problem in the new environment. We've gone from a decade of largely quantitative easing, of central banks suppressing volatility, to a new period this year of interest rate increases and quantitative tightening. Over a dozen major central banks globally are raising rates, including the Fed. And after 2 years of crisis-era fiscal stimulus, governments globally are pulling back dramatically on the fiscal spigots, which had previously been wide open. And in markets, we are going to a new period of much higher structural volatility. January is a case study in that. I don't think it will be as volatile as January throughout the entire year, but episodically, it will be much more volatile in markets than much of the last decade for a whole host of reasons, but in particular related to the pullback on both monetary and fiscal stimulus. Rising rates, very modest credit spread widening, and lower investment portfolio returns, given how high valuations are all attributes we expect in the year ahead. And as all of you know very well, after 4 decades of building efficient, low-cost, just-in-time global supply chains, we are in a new period of formidable supply chain dislocations, of companies and governments reshoring supply chains, not necessarily to home, but certainly closer to end markets. And to achieve these aims, we are seeing massive increases. After a decade of low corporate CapEx expenditure, we are in the beginning of a mega cycle, we believe, in corporate spending toward productive, technology-intensive, and green, sustainable investment. This is the new regime that we are in as we enter 2022. So let's hit a few of these topics. I'm going to move more quickly across many of these slides. And let's start with the global economy. Most importantly, this notion that over a dozen major central banks in the world are tightening policy, led by the Fed in particular, who has become increasingly hawkish since October. As a matter of fact, China is the only major central bank in the world that is easing policy in the year 2022. And of course, part of the concern in markets is that both the Fed and other central banks globally do unfortunately have a track record for tightening policy too quickly. We are in a regime of rising inflation, of central bank tightening, and we know from history that when that happens, financial conditions often tighten too quickly, asset price volatility picks up, default cycles increase, and the transmission to the real economy by a tightening of financial conditions causes the business cycle to shorten. And that is what markets are concerned about today. Said another way, it will not be easy for the Fed and other central banks to address inflation while simultaneously engineering a soft landing for the economy. Can they do it? Yes. Will it be difficult? Yes, it will. A quick look at Washington, which has led on the fiscal policy front. I highlight it because many of our multinational corporations are exposed to Washington tax policy. Back in December, the expectation was for, believe it or not, another $1.75 trillion of soft infrastructure out of the United States. I love the quote in the lower left. It's Joe Manchin's world. The senator from West Virginia, we're just living in it. He, of course, has enormous power in a Senate that only has a 1-vote majority. And he pivoted in December, as you know, against this bill. And we are now looking at potentially no soft infrastructure bill at all. The hard infrastructure bill last year was already passed. But we are potentially looking at no soft infrastructure bill at all over the next couple of months, or possibly something small. We think there's about a 50-50 chance of something in the 300 to 700 billion done. And in that scenario, we are expecting Congress to very modestly increase taxes, implementing a corporate minimum tax and a 1% excise tax on share buyback. We are not expecting, which is quite different than the view 6 months ago, we are not expecting any change in the corporate US statutory tax rate. We are not expecting any change in the overseas GILTI tax rate that so many multinational corporations are focused on. So this is a new base case scenario for Washington going into a midterm election year. We are expecting very little out of Washington in the year ahead. And if this small bill is not done by Feb 18, which is when there was a government shutdown deadline, we don't think anything in Congress gets done between February and November when the United States has midterm elections. Taking a step back globally, I think it's worth noting that growth will decelerate in 2022. It has already begun in almost every major economy globally. But while growth is decelerating, and it is decelerating quickly, I still think it's more important to emphasize that growth is still well above historic long-term trends. The United States, for example, expected to grow 4% this year. Yes, that's down from last year, but that is more than double normal US growth. Europe forecast to grow at 4% this year. Yes, that is down from last year, but that is almost 4 times normal European growth, which is considered by most economists in a normalized environment longer term to be in the 1% area. Similar comments for the UK and other countries. One area we are watching closely, this is both a short-term and a medium to long-term dynamic, and that is this idea that China is rebalancing and slowing. And this matters a lot for countries that have high trade dependencies with China, of course, Europe being one of them, East Asian economies, emerging market currencies, or any country that is heavily dependent on China as a buyer of global commodities, Brazil and South Africa, Peru, Colombia, and others being on that list. China this year is trying to also manage a soft landing of its economy, trying to avoid the hard landing scenario. And even in the optimistic scenario, we're talking about China growing at 5% this year. That is half of the level of a decade ago. And of course, the concern is that the real number could come in the 3 to 4% area. But the base case view is 5% with the constraints of Omicron, a more tepid consumer, a slowing export sector, and a major problem, as we all know, in their property market. China is structurally shifting their growth model to be more inward focused. They are emphasizing, and Xi Jinping is emphasizing the security and the resilience of their growth model more than the absolute growth rate. It is becoming an increasingly centralized and command economy. They are facing structural rivalry issues with the United States and other Western countries. This is a new dynamic that we are paying very close attention to in the year 2022 and beyond. As it relates to supply chain dislocations, and many of you know a lot more about this topic than I do, the consensus on Wall Street is certainly for moderation in the latter part of the year. And I think there's good reason to be optimistic around that. But I think this is a very, very complex problem. And even in the best case scenario, Omicron has likely delayed that moderation by at least a couple of months. What you see in the red boxes here are the sources of the demand shock. We are in the middle of the largest demand shock since World War II, in Western economies in particular. And that is because of a remarkable vaccine rollout. As I mentioned earlier, 10 billion vaccines globally, not the most even and perfect vaccine rollout, but nonetheless a remarkable accomplishment. Over 30 trillion of policy easing, over 5 trillion of excess consumer savings. But in particular, changing consumer behavior patterns. Consumers in the United States and globally shifting dramatically away from services and toward goods, clicking and purchasing from their home computer, which of course has increased the demand massively for container ships in particular. The challenges here to resolution are manifold, and we want to emphasize, as you know better than I do, that the resolution here is going to have to occur across the entire transportation and logistics network, including shipping, but also trucking and warehousing and storage and labor. So we need the demand side in the year ahead to normalize. And that can only be accomplished with a effective virus suppression strategy. And we are hopeful that we are in the very late stages of this virus pandemic. I do believe that COVID will be with us for years, but if we can make that transition this year from pandemic to something that is more endemic, that will certainly resolve a lot of the demand challenges, and then the supply chain will be better positioned to resolve the challenges in its path. We are closely watching this new index released by the Federal Reserve Bank of New York. It is showing that supply chain pressures are at their highest levels, as you can imagine, since 1997, when the index data became available. This index examines over 27 different variables, cross-border transportation costs between countries, the United States, China, Europe, Japan, South Korea, Taiwan, and UK. Over 27 variables. In December, it was showing signs of peaking and moderation. That has since changed because of Omicron, but this is an index that is well worth watching closely and something that we will have our eyes on in the year ahead. As you well know, there is no resolution to the problem in our ports, especially in the United States, where over 40% of container ships into the world's largest importing country are coming in through two ports only, Los Angeles and Long Beach. And as you know, in a ranking of the 350 largest ports in the world, Los Angeles and Long Beach rank something like 328 and 331 respectively. We are not going to be able to improve efficiencies in these ports unless we have massive investment. But on top of that, we also need to resolve the labor market shortages that exist in many parts of the world, in the United States in particular. And we think that this is something that is going to take much longer than the year 2022 to resolve. And that is in part because when you think about the very complex cocktail of things driving the labor market shortages in the United States, we see COVID-related factors on this list here on the right side of this page, COVID-related fears, visa restrictions related to COVID, elevated consumer savings. These are all things that should resolve themselves over the course of 2022 or improve dramatically as COVID dissipates. But there are many other factors driving this labor market shortages on this page that we highlight that are structural in nature and that will take longer to resolve. And that is the accelerating baby boomer retirements, the decade-long trend of declining female workforce participation in the United States, the mismatches between job needs and skill sets, and the decade-long disruption from technology disintermediation. This is complicated, this is structural, and it will certainly take much more time than the year 2022 to fully unwind. We're also, from a supply chain imbalance perspective, very focused on the microchip backlog. As you know, the semiconductor industry is one with intense regional concentrations globally, with a tremendous amount of the R&D happening in the United States and Europe, over 70% of the manufacturing happening in Taiwan and South Korea. If you talk about the most sophisticated microchips, it's actually 100% manufactured in Taiwan, and a tremendous amount of the packaging and assembly taking place in China. And these are very complex, very concentrated, and very regionalized supply chains. And as a result, it's not surprising to see that on this monthly data reading that we receive in the market, the gap between chip order and delivery, in December, it actually got 1 week worse, from 25 weeks up to 26 weeks. And listening to the CEOs and CFOs of many of the largest semiconductor manufacturers in the world, this is another market where resolution of the supply chain dislocations are going to take a longer period of time to normalize, potentially end of 2022, well into 2023, depending on how the year unfolds. Against this backdrop, it is therefore not surprising to highlight that inflation has risen considerably in the last 4 to 5 months. I think the good news here is in the insert chart that you see, the white chart in the middle of the page. It's important to emphasize that COVID-sensitive parts of the economy are still the primary driver of inflation higher. We are concerned that inflation is broadening outside of the core component into sort of, less pandemic sensitive sectors as well. But the predominant driver of the inflation is still COVID related. And that probably explains why forecasters are generally optimistic that inflation by the end of 2022, but certainly by mid-2023, will begin to normalize considerably. This will vary considerably by sector, as you see on this page. There are some industries globally and in the US experiencing massive inflation. And there are others that are experiencing disinflation, some even experiencing deflation. So this normalization and this general commentary I am making will vary significantly by industry. But there are good reasons to think that by the end of this year or early next year, that the inflation numbers across many parts of the economy should improve, in part because we will have more favorable base effects. The year-over-year comparisons will be to higher numbers, and so that will improve. Energy prices, we do believe, are approaching cyclical highs over the next year. We do have absolutely no question a decelerating global economy. We do think the consumer will normalize and rebalance their behavior more towards services, just as they did 2 years ago and last year in the spring. We think that will be even more so this year. There is massive global production and supply increases underway. Companies are getting better at managing the supply chain disruptions, even though they continue to be difficult, and monetary and fiscal stimulus is tightening. These are all major forces that are exerting downward pressure on inflation, but we would emphasize that this will take time. Against this backdrop, the imbalances in the global economy, the pullback on liquidity, we are in a fundamental new regime for markets. Just let's look at the Fed balance sheet as a microcosm of what I'm talking about as it relates to monetary tightening. The Fed's balance sheet, remarkably, as you look at the right side of this page, actually doubled during COVID, from almost 4.5 to 9 trillion during the COVID period. Think about that number. So the Fed is not only increasing rates in the months ahead, but they are also going to they have already begun to slow down the pace of balance sheet increase. And by mid-year, we think they're actually going to begin reducing the size of this balance sheet. It is our recommendation, the rate strategists at MUFG, that they unwind about 1 trillion of this excess liquidity over the next 3 years. It's worth noting that for every 250 to 300 billion the Fed takes down this balance sheet, we would say that equals approximately 1 25 basis point rate hike. And the market right now is pricing somewhere between 3 and 4 full Fed rate hikes over the course of the year ahead. So the Fed has gone from a year ago, the market assigning a 0 chance of even 1 rate hike in the year 2022. That's where we were a year ago. Let me just restate that. 1 year ago, the market was assigning a 0% chance of 1 Fed hike in the year 2022. The market today is assigning almost 100% probability of 4 rate hikes. That is how much the environment has changed from a policy perspective. And that is in part why we are expecting structurally higher volatility in the year 2022. Now, when we talk about regime change in markets, it's not just monetary policy. There are many other things going on. Of course, technology, the way in which it is transforming markets. But we'd also like to highlight the greening of the global financial system that is well underway. And we believe this to be a pervasive and transformative trend that is irreversible. And I will show you some data around why we think that is the case. First of all, last year was the first year that ESG bond issuance volumes surpassed 1 trillion. They doubled in just 1 year, and they are expected to rise over 50% in the year ahead. And it's worth noting that there are now over 150 trillion of investment funds globally that have formally committed to an ESG agenda. 4,000 signatories to the UN Principles for Responsible Investment. And that is not just sort of some gratuitous signing. These are funds by virtue of signing on to the UN PRI standards that are held accountable on an annual basis, or they risk being delisted from this initiative, to showing and demonstrating that they incorporate ESG factors into their investment decision. And just speaking anecdotally, we speak to some of the largest investors in the world: BlackRock, Vanguard, State Street, many others, allocators of trillions of dollars of global assets under management. And we would say that ESG-driven investment is their number one priority, and that they actually view it as existentially critical to their own business strategy. And so we expect this to only increase in the years ahead. So against this backdrop of global supply chain dislocations, of decelerating growth, of the regime change in our markets toward higher volatility, it's interesting, against such a challenging and complex environment, to highlight that the largest 500 companies in the world, the multinational corporations that we speak to, are actually in a position of strategic strength. And that is in part because they've just spent 2 years fortifying their balance sheets with record debt issuance, with record cash flow, record earnings, record margins. There's now an estimated 7 trillion of global corporate cash balances. Margins and earnings at record levels. It's interesting to note that during the COVID crisis, earnings collapsed more than they did during the financial crisis, but they also bounced back at a much stronger pace. And so in the year ahead, we expect earnings to normalize, but we do expect at a 9.4% growth rate, earnings to normalize at a level above the pre-COVID trend. And what I would highlight to you is that while in Q1, I would not be surprised to see a wave of earnings disappointments because of the impact of Omicron, because of the impact of inflation and supply chain dislocation. The pattern of the last 2 years, and I expect this for the full year 2022, the pattern of the last 2 years is that investors have continually underestimated the ability of corporations to make strategic adjustments to drive higher earnings, higher margins, and higher cash flows. And this is something that we expect to continue in the year 2022. We had record buybacks in each quarter to end the year. We still do not have the Q4 number, but we are expecting a number at least as strong as Q3. Q3 was the highest the highest buyback quarter in the history of the market. Last year was also new highs for dividends, though the growth in dividends still lags earnings and has room to grow. And most importantly, financial conditions remain favorable, even though volatility is higher. Financial conditions as measured by stocks, credit spreads, interest rates, how the dollar trades, and so forth, remain historically at easy levels. And this is perhaps one of the most important questions for this year, is that as volatility picks up and as the Fed and other central banks tighten policy, Will these financial conditions remain at historic easy levels? That is perhaps the most important question for financial market conditions in the year ahead. But against this backdrop of fortified balance sheets and high earnings and cash flows and cash balances, we are expecting corporates, as they have done historically during times of supply chain and labor market shortages, to invest heavily in productivity-oriented investments. That is what has happened historically at times like this, and it's exactly what is happening now. Corporates have ramped up the pace of CapEx spending across three areas in particular: the vertical integration of supply chains, number one; technology-heavy investments and productivity-oriented technology investments, number two; and number three, sustainability and climate-related investment. On the right side of this page, you can see that the percentage allocated toward R&D as opposed to physical structures and equipment, the percentage allocated to R&D has increased sharply as well, such that across S&P 500 companies, we are in the midst of the strongest CapEx cycle since the 1940s. Not only do we have the largest demand shock since World War II, not only do we have some of the largest supply chain dislocations since World War II, we also have the early stages of what is already well underway to be the strongest CapEx cycle since the 1940s. Global M&A, as I suggested earlier in this environment, the strategic activity of corporations is running at record levels. Last year was the first $5 trillion M&A year globally in history, breaking through all records historically, all norms historically. It was the first year where every single quarter of the year had over $1 trillion of global M&A. And yes, that happened because of the vaccine and the knock-on effect to CEO confidence and the high corporate earnings and the strong equity valuations and low-cost debt. Yes, those are historically have always been drivers of increased strategic activity. But what I think is unique to COVID is what you see on the right side of the page, and that is a competitive landscape for corporates across all industries that is evolving faster than perhaps it ever has before. And that, in turn, is due in part to technology's disruptive impact: technology disruption, technology dislocation, technology disintermediation. And this, we believe, is a true feature of the COVID period and will only accelerate in the post-COVID world. And so we expect heightened CapEx activity and strategic activity to continue. Now, when we think about and talk about the trends that are driving M&A, I would point you not only to mega deals like what we saw from Microsoft last week with their $80 billion announcement, and this is happening across all industries, not just tech. But I would also point you to point number two on this page, this idea that for the first time, well over 50% of deals are what we call scope transactions, as opposed to scale transactions. Scale transactions are large acquisitions where companies are trying to achieve economies of scale, cost savings, consolidation. Well over 50% of this record activity that we're seeing today is more about scope. It's more about acquiring new technologies, new capabilities, new product portfolios, new distribution capabilities, new geographic footprints. That is what is new and so exciting and different about this M&A environment. And the competition for assets in this environment is fierce because you have companies competing with private equity and venture capital and SPACs at record levels to drive M&A valuations. Technology is a huge driver of this activity. Cross-border activity, believe it or not, even though regulatory scrutiny on cross-border is higher than it has ever been, cross-border activity is running at record highs, though I think it's important to note that most of that record activity in cross-border M&A is being driven by the United States and European deals. with US-Asia volumes actually down in particular and largely because of the decline in activity between the United States and China. You see here in this chart that corporate investment in software, information processing, and R&D is running at record levels of GDP. These are trillion-dollar increases in R&D spending. And technology as a percentage of global M&A doubled last year over the 20-year average, up to 27%. And 400 billion of private equity deals, a doubling from the prior year, were also technology sector deals. Let's go to the next section, resilient US dollar credit markets. We are going to need significant funding for all of this CapEx and strategic activity and ESG and green investment that will be required. And we do believe that even with structurally higher volatility, that US dollar credit markets will continue to be resilient. While some markets, equities in particular, are entering later cycle stages, we believe US dollar credit is still very much mid-cycle, as evidenced by the declining leverage ratios, the improving fundamentals, and the strong technicals which continue. As I mentioned earlier, over the last 2 years, there has been over 32 trillion of fiscal and monetary stimulus globally, 13 trillion in the United States alone. And globally, when you think about credit markets, we can't just focus on the fundamentals. It's equally important to focus on this idea that the technical demand for corporate credit, for balance sheets such as your companies, among investors is enormous. And that is due in part to the fact that there are now over $250 trillion. Think about that number. That is 3 times global GDP. 250 trillion of funds that need to be put to work on a daily basis in global fixed income markets. Over 120 trillion of global asset management money, over 42 trillion of global pension fund money, 39 trillion of global insurance assets, so on and so on and so on. This is a huge part of the reason that even with volatility higher, that government bond yields remain low and that corporate credit spreads remain reasonably tight, because these are funds that need to put their money to work on a daily basis. Default rates in the market from a fundamental perspective remain very low. Of course, we had a full turn in the credit default cycle at the beginning of COVID, but that is now behind us. And corporates are actually deleveraging with strong cash flows, driving default rates to very low levels. And against this backdrop, we do expect credit spreads to remain range bound. Now, in months like this, we will test the middle to higher end of these ranges. But historically, or let me just say it another way, by the standards of history, we expect credit spreads to end the year and to spend much of the year in reasonably tight arenas, both because fundamentals and technicals remain strong. And so even though rates are increasing a little bit, and even though spreads are widening a little bit in the volatility of January, you can see here from a 20-year perspective that the absolute cost of debt, the total yield on corporate bonds, is still extremely low on a 20-year basis. Let me conclude here in the last 2 minutes with a few final comments about this new era that we are in of big government. I think it's important to emphasize that historically, during times of war, as happened after World War I and II, but also after times of crisis, as happened after the global financial crisis, and also as we come out of COVID, governments, when their role in the economy becomes much larger, either to bail out an economy or to rebuild an economy from the travails of war or from the travails of crisis, whether that be global financial crisis or COVID crisis. When the government puts their wallet to work, they tend to become much more involved in the economy in the period after. And that tends to mean more intrusion of governments in the private sector higher regulations, higher capital standards, and generally speaking, higher taxes. And that is exactly what we are expecting in the years ahead coming out of COVID. If you take more of an historical look at it, you can see that we had two major globalization waves over the last 200 years. The first one was in the late 1800s with the major advancements that had took place in the transportation sector, driven by new technologies with steam engines and industrial processes and so forth. And then following World War II, with the signing of the GATT trade agreement, we had a new era that accelerated when China joined the WTO in 2001, a new era that lasted about 75 years, the second globalization wave of the last 200 years. But since the financial crisis in 2008-9, we have arguably entered a new period of deglobalization, driven not just by populism and nationalism, but by a number of factors. Now, some of those are structural factors. China naturally slowing down, coming out of the financial crisis, banks being more tightly regulated and their cross-border lending being more closely managed and watched. And global supply chains reaching, even before COVID, probably the outer boundaries of their growth capacity. The US-China trade wars and the COVID crisis, in our view, precipitated a new wave of policy factors now on top of the structural factors that are driving this era of deglobalization. And that is creeping protectionism, rising techno-nationalism, rising US-China structural rivalry, an increase in anti-immigration sentiment, cross-border bank deleveraging, which is a decade-long phenomenon now, and greater scrutiny of cross-border M&A. So in conclusion, I would say that we are optimistic about the year ahead, but it is certainly a much more complicated environment. Growth is still more than double the pre-COVID norms. We still have an enormous amount of fiscal and monetary liquidity in the system, even though we are tightening. Credit markets are in absolutely fantastic shape. But at the same time, as we know, public health risk globally remains high. Economic risk remains high. Inflation and supply chain dislocations remain formidable, even if they are on a slow path to moderation. Socio-political risk and geopolitical risk also remain high. So this is a very complex environment, and we wish all of you and your companies and your families the very best of good health and good fortune in the year ahead. Thank you very much.
Thank you, Tom. Very interesting presentation and the outlook, what we are seeing right now. Despite a very dramatic pandemic, I think there's, based on your presentation, some silver lining here. It's not just doom and gloom. I want to touch first on a little bit on the supply chain. And do you think that you mentioned that investment in ports and infrastructure is essential, but how? I mean, you notice in the public view, ships are the ones that are being portrayed. All these 70, 80 ships anchored off Los Angeles, Long Beach. It's causing the problem and why your grocery bill is more expensive. But how do you sort of see the policymakers tackling this problem, and how do we move forward with this?
Well, one of the things first of all, thank you so much, everybody, for having me this morning. It's a pleasure to speak to this audience again. I think, as I emphasized in the presentation, we will not resolve the supply chains by simply looking at the ports. We need a holistic solution across the entire logistics network. By the way, part of that, a huge part of that, is on the demand side. Unless we get a stronger grip, and of course we've made enormous progress on this, on the public health side, and get the consumer to rebalance their behavior in a more normalized direction towards services, right? if I were to over stereotype, everybody's at home for the last 2 years, clicking away on durable goods that need to be transported in container ships. So once we get the consumer in the US and globally normalizing their behavior pattern on the spending side, on the demand side, that's going to provide relief. Yes, we need investment in the ports, especially in the United States. That's a medium to longer term issue. That's not going to happen sufficiently in the course of 2022. We also need massive labor market improvement. And the good news is we saw on Friday's jobs report, that's exceeding expectations thus far this year. That's a real positive silver lining in markets this year. 5 weeks into the year, we've had a lot of bad news in markets, but the labor market side has improved dramatically. And unless we address the labor market shortages in the United States, the US did not address labor markets as well as Europe did during the COVID crisis. There are other things that we did much better than Europe, but labor markets is an area that we did not do as good a job as Europe during the crisis. And so that's going to take longer in the US. We're already seeing improvement there. And so those labor market improvements will help address the trucking bottlenecks, which in turn will provide relief across the ports. Let me just say one last thing. I listened to a conference call 2 weeks ago led by the head of supply chain management at FedEx, one of the largest transportation companies in the world, the head of supply chain management at Stanley Black & Decker, one of the larger industrial and durable goods products companies in the world, and the head of supply chain management at Hewlett-Packard. And I was struck by the lack of visibility from the heads of supply chain at those three very big corporations, the lack of visibility in their view on when we do start to see some significant relief. I think they were, and I am still optimistic that that begins to happen toward the second half of 2022, but we need holistic demand and supply side effort to achieve those goals. It is certainly not the shipping industry, in our view and the view of most economists globally.
Finally, as a wrap up, you didn't touch too much on this in your presentation, but I think we cannot ignore the present situation in Europe with Russia and Ukraine. But recently, the issue or the discussion with Germany relating to the threats issued by the US, particularly with the Nord Stream 2 gas line. And if it comes to the point of threats and implementation of threats, that's kind of a two-edged sword. How can that, obviously the threat is to punish Russia, but you would presume that lack of import of gas through this pipeline and the effect of Europe and world trade. I don't know if you had a quick final thought on that issue.
Very complicated. We've spent a lot of time on the Russia-Ukraine crisis. Quite honestly, Europe's heavy dependency on Russia gas, as you know, approximately 40%, and Germany arguably over 50%. That has actually created a massive vulnerability, right? And it's not a coincidence that Putin is pursuing this policy in peak winter. There's a lot of reasons why he's doing it in peak winter, the lessons of history, in terms of this region, but Europe's gas dependency is certainly part of it. I would kind of look at the issue slightly differently and say that vis-a-vis where I thought we were 3 weeks ago, the Western response, the NATO response, the coordination between European countries and the US has far exceeded our expectations. I think when Putin began to assemble on the Ukrainian border, there are so many things at play, but certainly a big part of it was a calculation by Putin that the West was weak, that Trump had pulled back on NATO, that Trump had implemented tariffs on his European allies, that Biden had a sloppy withdrawal from Afghanistan, that Biden and Boris Johnson's approval ratings are exceptionally low, that Macron is going into an election. I think that the timing here is not a coincidence at all. And I think Putin is looking at the West currently as weak and fragmented and looking at what Xi Jinping is doing to the east and shoring up his borders in Hong Kong and potentially soon in Taiwan, and seeing an opportunity here. And I think he miscalculated. I think that the response from the West, and I understand that the threats around the Nord Stream pipeline is a tricky situation to manage, but I think maybe the more important point here is that the West has actually had a very swift and strong response. And I think now that a diplomatic resolution, while it may not be the most likely, it may be, it may not be, it's very much on the table in a way in which it was not previously, because I think Putin knows that a limited incursion into the east, which I think was his base case plan, is going to come at a massive, massive cost. So very complicated discussion. Let me make one final point on this. Whether he goes in or not, I think rising energy and oil prices has really risen to the forefront as a huge risk for 2022. Our oil analyst at MUFG just this week increased his oil price target for the end of the year by $15. He was previously forecasting $89 a barrel for the year end. He's now forecasting $105. So that is a big increase, and many other oil analysts on the street. That has implications for economic growth, for Fed and ECB policy, for inflation, and so on.
Well, great, Tom, and thank you so much for that. And we'll see how that oil prediction affects particularly our VLCC market and how that's going to be moving during 2022. So again, thank you for joining us. I think that this set the course of the conference on a right path. Appreciate your views, very valuable and interesting as always.